Well, welcome back to another episode of the Financially Free Journey podcast, and I'm your host, Courtney Dyer. Today, I have Chris Naghibi with me, and he is the founder and chief executive officer of Black Crown Incorporated, Black Crown Law. He also just started a bank called First Foundation Bank, and it's just so exciting to be able to have Chris come on the show. The accolades that he has is unparalleled, and we are going to really be diving into real estate and how to invest in real estate and a lot of the hurdles that you may see come up when you are researching and trying to get your foot in the door. So, Chris, welcome to the show.
Thank you for having me. I appreciate the opportunity.
Well, so first of all, you started your own bank, like you have been doing this for a while, my friend. So please tell the listeners just a little bit more so they have context about your background and what you specialize in and how you've gotten to this point.
Yeah, sometimes I don't even really know the answer to that. It's kind of one of those lifelong pursuits, right? Like you dive into something and we all hit that bell curve in our mind where we feel like we know a lot about something. And then the older and more sophisticated you get and the more experience you get, the more you realize you don't know that much. And my journey has really been trying to figure out how much I don't know about things. It wasn't necessarily myself that started the bank. It was myself and a group of investors and friends. And I serve as a chief credit officer. And in that role, there's a lot of responsibility. And I figured early on in my career that the broader I could get with my background as it relates to our primary products, which in this case are multifamily apartments, single family, and a lot of residential lending, as well as your business and C&I lending. We wanted to spend a lot of time in those spaces. I wanted to be as sharp and as skilled as I could in each one of those spaces, and each one of them required a very unique and different discipline. So I took the time to really do the things that I could personally and professionally to build myself around those professions. And it's been a labor of love. I am a nerd at heart, a lawyer by trade, and I love real estate. I love the nuance of the business and just kind of figuring out the things that I didn't know and I still continue to not know. And that's led me to a path where all these kind of businesses have manifested from those curiosities, if that makes sense.
Well, yeah, again, it's not pigeonholing yourself into one particular aspect of the industry. Really being well-rounded is something that I think is really attributes to a lot of people's success. It's like I dabbled in a few different areas because then you can find your passion, but then you have some, great experience as well to fall back on. And it sounds like you definitely have the experience necessary that brought you to the point where you're at now. And so tell us a little bit about First Foundation Bank and what you guys do exactly.
Yeah, so we started the bank in October 2007, and it's been an interesting journey. Starting a bank in it was the height of the Great Recession at the time. There was a lot of stigma to what we were doing in that, who starts a bank when people aren't lending money? But when you think about it in a broader context, that's actually the perfect time to start lending because you're the only one doing it.
Yeah.
So we all have a passion for multifamily apartment lending for a number of reasons, not the least of which is that we feel it's the least risky product as a bank. And you as a consumer or you as an investor in real estate should take some comfort in that, because if that's the way that bankers feel, that generally means that you as an investor are getting the least risky product. So there was a lot of confidence from all of us going into it. I myself own multifamily property. I'm a real estate investor, and we knew that in the worst case event scenario of default, you always have the underlying apartment building, you always have the underlying land. So it's hard for us as a bank to get hurt in a worst case event scenario of default. So we slowly climbed up the ranks in the multifamily space, and we've slowly managed to grow our business and expand our product offerings. We offer single family residential lending as well. And we've gone from what is a traditional small community bank to what I really feel is getting closer to a regional or super regional presence. We're just under, I want to say 8 billion, probably 7 to 8 billion in size. It's a little bit in flux, but a lot of growth in a short amount of time for any bank that started when we did and how we did. And we do a lot of apartment lending as a reference. And because of that, we've been able to grow with some pretty significant clients who've grown their wealth as well. So there's kind of a partnership there as well, which is nice.
Well, and it's nice to know that, as you mentioned, the risk that's associated with multi-unit lending is not as risky as other opportunities that an investor could come across. So, sitting on the other side of the table from the bank, knowing, this is something that they consider to be risk mitigated with the collateralized property, it does give you some, solace to know, okay, this isn't as risky of as an investment opportunity as others may be. And it feels risky and complex when you're trying to break into building a real estate portfolio because you haven't done it before. And that's something I really wanted to hone in on with you today is, let's say the listeners have never invested in a real estate property outside of maybe their primary home, but they really want to get some rental properties. What
Mhm.
is the first step that they take?
So one of the things I tell people, and I get asked this question a lot, is that just because you own a home doesn't necessarily mean that you really have an appreciation for the process in detail. And I know that sounds like I'm watering down people's experiences, but think about it from an educational standpoint. We go through high school, we go through college. Nobody teaches us the basics, the fundamentals of how to buy a home, how to manage your credit, how to do the things financially to build wealth. So I like to tell people, if you have a passion for it, you need to learn about real estate. And I'm not talking about be in depth enough to be a real estate professional who does it every day for a living, but you need to know enough to really understand and appreciate whether you actually like this business and want to get into it. And the reason why I say that is owning real estate and having the passive income from it and possibly the equity upside, appreciation and value for your portfolio. Those are all wonderful things. But everything in life has a bit of risk, and finding your passion is appreciating not only the risk, but the reward. And in a lot of times it's taking in that risk and seeing if it fits your profile. Real estate is not the easiest thing for us to buy. Every property I buy to this day, myself personally, comes with that same anxiety, that same frustration, that same uncertainty, even though I financially am better off today than I was when I bought my first property. But you have to get through the process and understand if you can even handle that. And that's where a lot of people, I think, decide it's not for them. That, and I would say the property management side of the business. You can always hire a neutral third-party professional outside, property manager. They'll pay them, in multifamily in Southern California, somewhere between 3 and 5%. And they can manage the property for you. But you, as an owner, do need to know what a property manager does and what they should and shouldn't be doing. So I tell people to start there. And what I usually tell people is, if you have any interest at all, get your real estate license. Even if you never sell a property or you never buy a property on your own, the education alone is priceless. You learn about escrow, you learn about title, you learn about fiduciary responsibility, you learn about a little bit about landlord-tenant law, you learn about real estate law, definitely. And those things will help catapult your education to the next level when it comes to you coming to buy a property. Does that make sense?
Absolutely. Again, increasing your own knowledge never hurts. And so if you're able to get a real estate license, that's going to give you a really good holistic view of real estate, the market, the semantics of how it works. Because again, that's where people get intimidated, is by the things that happen behind the scenes, right? When it comes to actually purchasing property, because it isn't the easiest process by any means. So one question I want to dig a little bit deeper, because again,
Mm-hmm.
you are a real estate investor yourself, but then also from the banking standpoint, I want to talk about the underwriting process because,
Yeah.
as we go to purchase a primary residence and, there's certain guidelines, right? A debt to income ratio can't be above 45%, typically the loan to value ratio. It's very standard. They're going to review your income, and you're going to have to put down, 3.5%, typically up to 20%. So I want to talk about what the listeners can expect to really have to be able to meet the guidelines when it comes to underwriting for a multi-unit property.
As a guy who wrote the credit policy and the underwriting policies, procedures, and guidance, I think you're probably talking to the right guy.
You're the right guy.
Yeah. So what I will say is that for all the listeners out there, because everybody has a different set of background, a different set of experience, I want to be clear. Multifamily is always 5 units and above. Anything that's 1 to 4 units, or basically 1 to 4 doors, is going to be in your single family world. They still underwrite them very much like single family. Everything we're going to talk about moving forward is going to be that 5 units plus. Okay. That is multifamily as far as underwriting is concerned. So if you're looking at buying a duplex, a triplex, a fourplex, you're going to still, conform to all the traditional single family underwriting that you normally would. And I do tell people that's a great place to start. There's nothing wrong with starting that way. The sheer definition has really been established more by agency guidelines and how these things are sold in the secondary market, and less as a reflective of them being a little bit more or less complex than one another. They're really, if you're owning a 5 or 6 unit property and you own a 4 unit property, they're really no different. It's just that they're defined differently by the way they're packaged and sold in the secondary market, if that makes sense.
Yep.
So if you're buying a multifamily property, you need to take a bit of a step back and appreciate the fact that these are considered to be riskier investments than a home. And the reason why is that if you have a home and you live there, you're going to do everything you can to protect where you live. It's by nature of humanity. We need some place to call our own, right? So typically speaking, people are more likely to default on something that's an investment property because they're not sacrificing where they live in a worst case event scenario. That being said, we've already heard that I believe that multifamily is a very, very safe asset class. So the main difference in how that relays down to the underwriting is that you're going to have to bring in more money for a multifamily property. So when you first get an LOI or a letter of interest from a bank, when you're trying to find a loan for a multifamily property, they're going to give you 2 real main indicators to determine whether or not they can make a loan to you and what their kind of caps are. The first indicator will be a maximum loan to value, right? Typically speaking, you're talking 75% at most in most areas. In Southern California, in areas where the land value is exceedingly high and the rents are very high, you usually don't get much above 65% in a loan to value. And that's because the ultimate determination of what your loan amount will be driven off of something called the debt service coverage ratio. And if you don't know what that means, that's totally okay. They just don't teach us these things in school. Unless you had a class on real estate investing in an MBA course or possibly in a program, then you likely didn't ever get this in school. The debt service coverage ratio is basically a mathematical equation that really takes, it's frankly your income over your debt. And it's typically expressed 1.25 to 1 means for every $1.25 in profit, you have $1 in expense. And it's usually relayed to you, the consumer, as a maximum debt service coverage ratio, in that case of 1.25. So what the lender will do is they'll underwrite your property. They'll take all the potential gross income, they'll subtract all of the expenses on an annual basis, right? And they'll come up with your total cash flow, how much cash flow is left in the property. Then they're going to come up with your principal and interest payments, and that is your debt service coverage ratio. They're going to divide what's left over that small amount that's left over, and you get that ratio they're talking about. That is really what derives the loan amount in the multifamily space. It has nothing to do with your sponsorship as an individual. The only thing that really they focus on at the first part of the underwriting is making sure the property will cash flow, because they don't want to make a loan on something that's cash flow negative, and they can't and they won't. And secondly, do you have the cash to come in to close that transaction at that underwritten loan amount?
Now, are you starting a new business and you might be concerned about using your personal number? Well, for less than $13 per user, you can get a business line with Flex Plans. This is the all-new business phone plan by Virtual PBX. Flex Plans provides unlimited calling, business texting, video conferencing, all for entrepreneurs that need a way to connect with their customers. And it includes a free soft phone, plus it includes 2 free local toll-free numbers, a virtual receptionist, professional greetings, call forwarding, voicemail text, and just so much more. So right now you can save 15% by visiting virtualpbx.com/podcast. Now that's less than $13 per user for your business line. So separate your private line from your professional line today by visiting virtualpbx.com/podcast. It's very different in regards to thinking about your primary income. Can it cover, buying the home that you're looking at versus the debt service coverage ratio of the property being able to cash flow itself? So it's, we're not necessarily looking at a personal guarantor reliant loan when we're underwriting. We're looking at the property being able to cash flow itself. A follow-up question to you, Chris, is it best for the listeners to look at forming some type of a business entity to do these transactions under, or do they buy these, investment properties, just themselves?
So there's a lot of different schools of thought around this. Obviously, I've got a legal perspective. I will give the asterisk here. This is not legal advice. This is just the commonalities that I see, and I will explain some of the legal nuance behind them. Yes. And you can make that discretionary decision for yourself. So the banks are always going to look to three sources of repayment when it comes to a multifamily property. Number one is the cash flow. It has to cash flow to that debt service coverage ratio. The second is going to be the equity or the loan to value of the property, how much equity is left in it. And the third is your individual sponsorship. Now, you, as somebody who's buying the property, you need to look at it from number one, the cash flow. Is this going to make sense for your passive income? Do you have the money? And then third, how do you protect yourself and your assets from any kind of litigation risk, right? Or how do you protect yourself? You can put it in the name of a trust. You can put it in your individual name. The most common methodology, however, for multifamily properties is you put it in the name of a limited liability company. So that whether it's single asset, single purpose or not, it varies. Most people want to have one LLC with several properties in it. Now, you do have litigation risk. If one person has an issue on one property and they sue you, they can get to all the other LLCs if the judgment was significant enough. That's really a personal decision. But I will tell you about the LLC vehicle is it's got significant tax benefits for passive income. And it is by large accounts, and it is the most common way that CPAs prefer to hold real estate because you get the best tax positioning for yourself, and you get a little bit of protection in the form of a limited liability company owns the real estate and not you personally. There's a separation. There's that corporate veil which protects you and your other assets outside of that LLC.
We are really getting the insider scoop here, Chris. I am liking this information. So we've talked about the underwriting process, right? For multi-unit, we know that's 5 units and up, guys. And then also, what is that debt service coverage ratio? And really, the aspect of, are you going to put it into an LLC? What does that look like for you? And again, make sure that you research that and you consult with a CPA if you have one, an attorney for your personal situation. But it's really good to get the gist from you as far as kind of what that standard looks like in the industry. Another question that I have, kind of moving away from the underwriting aspect, this is more from the investor point of view. How the heck do you identify a good investment property? I mean, there's so much information out there that can be conflicting. And so that it can almost be paralyzing for someone that's trying to get into it and they haven't done it before. So do you have a methodology that you follow, or maybe some bullet pointed information that the listener should look into prior to making an offer on a property?
Yeah, I'm a bit of old school in the way I look at things. I tend to be very, very simple about it. There are very complex Excel sheets that people have for comparison of markets. Some people look at cap rates as a way to compare similarly situated investments. I tend to take a different philosophy, and it's very, very basic. And I'm not saying this is the absolute best way to do it. I'm just saying, me as a person who buys real estate, as a person who works in this business in a number of different capacities, this is what I found to be the most comfortable for me. If I'm looking to buy something, I want to know how much free cash flow on a monthly basis and subsequently on an annual basis that investment is going to return for me. So I'll use a very, very simple example. If I'm going to buy a single family property in the Midwest where I own a lot of real estate, and I'm going to put $40,000 down, I know that I've got $40,000 of my cash down that's working. Now I'm going to figure out what that property can rent for, what the market rent is. I'm going to figure out what my expenses are on a monthly basis. I'm going to figure out annually how much money I'm going to make. So the last property I bought, I put about $40,000 down. I think the mortgage was around $800 or $900, and the cash flow after I think it was $1,700 a month rent wound up being about $600-700 a month times 12. Let's just say $700. It's $8,400 a year in free cash flow for that $40,000 initial investment. That's a really good cash on cash return.
Right.
So I think to myself in a very simple way, where else am I going to put the money that's going to get a similar return? And there are a lot of people who will take a pause there and say, hey, Chris, you're not thinking about equity appreciation. You're not thinking about, the tax benefits. I'm not. And the reason why is I know real estate has got great tax benefits, but you could also counter argue that a real estate investment trust could give you the same benefits if you know how to do it the right way and if your CPA tells you how to take advantage of those things. The only thing I typically look at is that cash on cash return, where my money can go to make the most return on an annual basis. And frankly, as rates go down, one of the things I like to tell people too is be mindful of your rates, because if your rates go down, if rates in the economy go down and you can refinance and lower your rate and lower your payment, you're only increasing that cash on cash return over time.
Today's episode is brought to you by HelloFresh. Do you feel like you are stuck in a dinner rut? Well, with HelloFresh, you get fresh, pre-measured ingredients with mouth-watering seasonal recipes that are delivered right to your door. Skip all of those trips to the grocery store and really count on HelloFresh to make home cooking easy, fun, and affordable. And you can now enjoy cooking and getting dinner on the table in 30 minutes or less. With over 25 recipes to choose from each week, there is something for everyone to enjoy. All recipes are designed and tested by professional chefs and nutritional experts to really ensure deliciousness and simplicity. Now, go to the link in the show notes to get $80 off, including free shipping on HelloFresh, the #1 meal kit.
A multifamily investment is no different. The only thing that's really much more complex about a multifamily is coming up with that debt service coverage ratio and then backing into your loan amount. And after you've done that, your sole job as the owner of that property, besides property managing it, and anybody who underwrites you is going to assume you're paying a neutral third-party professional property management company. They're going to underwrite to that figure in your cash flow, so you might as well plan on paying somebody, even if you want to manage it yourself. If you have that in there, your main focus at that point in time is improving the property and creating more value and upside potential. The more cash flow any multifamily property or any frankly commercial property can generate, the more value it actually has, the more valuable that property is. It's not like your home where comps have a huge, tremendous impact. Multifamily properties, investment properties, they really come down to how much income it can generate. If you've got a building that's 4 units that rents for $2,000 a unit, it's inherently less valuable than a property that's 4 units next door that rents for $3,000 a unit.
There is a lot that goes into it, but I love how you laid that out because it makes it simple. So if you understand that concept, then you can really press forward and identify good properties. I had a thought while you were talking to, it's like Chris will be the right person to ask this to. What is your thought on the current real estate market? I mean, it is so crazy right now. I mean, as an investor, what's your thought?
Wow. Okay. So I'm sure I'm going to make somebody mad out there. So
it's a hot take, guys.
Before we do that, anybody who gets upset at this, don't listen to the end where they give out my social information because I don't want the email. But right. So I spend a lot of time, and by nature of what I do for a living, especially at the bank side, I'm looking at a lot of data. Reese, CoStar, now Reese is part of Moody's actually. I'm looking at Zillow's reports. I'm looking at all the Redfin, you name it. Everything that's out there, I tend to take in as much as I can. We also have a wealth advisory firm that I need to be somewhat cognizant of that has some SEC oversight, and I don't want to make any future forecasted predictions. But what I will say is we are coming from 13 years of artificial interest rate deflation. If you go back to 1929 to now, and you look at every recessionary economy, there's a chart that the Federal Reserve Bank, I think of New York, actually puts out, which is very, very well laid out. Recessionary economies typically last between 7 and 10 years. We are in a very, very unprecedented time. And to layer in the added complexity of a pandemic and some of the things that we've done there from a monetary and fiscal policy in response to that, and you've got a period of time where no one can really predict what's going to happen next. I would tell you that what goes up tends to come down, and that when typical recessionary economies last for 7 to 10 years and prosperous economies last about the same, and it's cyclical. And we've been in 13 years of an artificially interest rate deflated economy, and you've pulled the elasticity out of the economy. Think of it as a rubber band. You're going to have to pull really, really hard to get the momentum back. Okay, so some of the things we're experiencing now, one could easily argue, and certainly Zandy at Moody's is arguing this already, that we're already beginning to see inflation. You've pumped the economy full of liquidity, trillions of dollars of liquidity. Wood prices are skyrocketing. And you're seeing all this shortage of supply in the market. And yes, some of that has to do with the pandemic, but the end result is still the same. We are beginning to see early warning signs of inflation. And I'm not saying we're going to walk into a recession tomorrow. I don't want anybody to freak out. And again, don't contact me telling me that I'm wrong. I know that I'm not right.
Chris said so.
Yeah, Chris said so. He's terrible. There are believers in real estate who never want to believe that a recession is coming or that changes in values are going down. And what I would point out is there actually is a well-documented psychological phenomenon that when times are really economically frothy, when we are at the height of a recession, of a looming recessionary economy, that there is a pathological behavior that we have as humans where we don't want to believe that the end of this is coming. And you see the rise of gurus in the real estate industry. You see the rise of things. The flipping business goes nuts. According to the National Association of Realtors, On average, flippers are making $66,000 a home right now.
Oh,
That is a
wow.
lot of money in a business that was completely destroyed in 2007 and 2008 due to the recessionary. When the economy
Wow.
goes the other way, you lose all those profits. So I'm well aware that core logic, and a lot of people are saying that 3 to 5% increase in single family residence prices, next year. I'm well aware that there is a bidding war in every single property. Obviously, I run a brokerage. I'm involved in it. I see it on a daily basis. But I can tell you that I'm seeing more troubling signs as indicators right now than I've ever seen before. And I've never in my career, in my entire lifetime, and I've been in real estate since working for my father at 14, and he had a mortgage brokerage shop. I've never seen so many offers above list, no contingencies, no inspection, no appraisal.
Waiving inspections. My gosh.
It's insanity. And I can only tell you that you don't have to be a real estate investor to know that things that get this crazy typically have some kind of fallout, right?
Right. Absolutely. Absolutely. No, I couldn't agree more. And, as you mentioned too, with our monetary policy, pulling the rubber band back, there's only so much you can do until, we're going to see, a decline. And again, it is cyclical. We have seen this time and time and time again, and it's not going. It shouldn't be a surprise when it does happen. And again, we cannot predict or time the future, but just knowing that this has happened over and over, and it will continue to happen. And so, as someone that's looking at getting into real estate investing, is there a way for them to really prepare themselves to make sure that they are buying a good property? And as you mentioned, the debt service coverage ratio, but when we're talking about overvalued properties, is there anything that they should look at to maybe try to avoid that?
Yeah. So I will tell you that I typically buy at least 2 properties a year. In the last year and a half, I bought 1. And that's not because I'm not buying or not actively looking still. It's just because I'm looking to make sure that the cash flow is there. So I'm going to turn that frown upside down a little bit. I'm going to tell you, you should never stop looking for an investment property. I shudder. I stutter a little bit because I want to say deal, but I really don't. I really don't mean deal, especially in this economy. What I'm trying to tell people in this environment is, yes, you should still be looking to buy real estate, but you'll notice that everything that I've said to you has come down to 2 core, parts of my ethos. Number one, the value of the property means nothing to you. What you really need to focus on as an investor for your family's legacy wealth is cash flow.
Yeah.
If you're buying for cash flow and you're buying in a situation where you know that thing cash flows today, as of right now, and you've got a small buffer, however bigger it might be in rental income, there's $300 or $400 a month in cash flow, you're generally going to be okay. And that's all I'm worried about. I want my properties to all cash flow positive. It'd be nice to make a good amount on every single one of them. Most of my single family residence properties, that low end product that I typically buy, you're talking $400 to $600 a month in income, but 10 properties, not a lot of money. 20 properties, a lot of money. 30 properties, a significant amount of money. People get lost in these home run hits. You can't focus on that. You can still find cash flow positive properties today, even with these values. It just depends on where you're willing to go, how much risk you're willing to take on, and how much you know the market. And that's the other part of the ethos that I talk about a lot. Relationships are the truest form of currency. And people underestimate the hell out of the relationships they already have. They love to focus on, I don't know real estate, Chris. I don't have anybody I can talk to about investing. I don't know where to start. You do, you just don't recognize that you do. We all have a checking account somewhere.
Today's episode is brought to you by DB. Now, DB is a Scandinavian brand that makes backpacks and bags to help people on the move stay ready for anything. Now, from the streets to the peaks, DB's gear is travel tested by some of the world's best athletes, adventurers, and creators. And over the past decade, DB has designed and developed, released, and refined the best bags in the market. With DB's patented hookup system, you are able to attach smaller products to your backpack, your roller, or your tote. So we are teaming up with DB to exclusively offer you 10% off of your next purchase. All you have to do is use the code POD10, that's POD10, POD10, or just go to the link in the show notes. Guys, DB, it's time to move on and it's time to get going.
That's your first banking relationship. And if that banking relationship isn't willing or is unable to give you a loan, then I would highly recommend you find a community bank like the one that we are, somebody that you can actually talk to your lender and you can find out what their underwriting criteria is, what their requirements are, and you can build yourself up to that. And if
Yeah.
you meet their underwriting requirements and you find a property that checks all those boxes, then guess what? It's never the wrong time to buy.
Oh, I love that. Yes. Again, what a great form of currency, as you mentioned, because if you have the right relationships and the right information, you can make really good, informed decisions when it comes to making purchases like this. And so, starting out with your own bank, right? I mean, going and talking to your bank, and if they're not willing to help you, you should probably go look at a different bank because they're not valuing your relationship very much.
Yeah, and I like to think that the big box banks, and I've got a couple relationships with them. Most of my stuff's at community banks now, whether it's in the Midwest or here at my own. I like to go places where I can talk to somebody. I don't want to dial into a call center, 1-800 number. I want to have the local number of somebody I can call and I can work with. Not because I'm a high need guy. I'm not really that needy, frankly. Well, my wife says that I am, but whatever. But I just want to be able to talk to somebody and figure out what to do and how to build this relationship over time. And I'll tell you, I put my ego aside when it comes to real estate. And I think a lot of people need to do that. We were told as kids, be a doctor, be a lawyer, be an engineer, be all these things, and you're set. But really, the real estate game has a way of humbling everybody. It doesn't care who you are or what your
Yeah.
education level is. It doesn't care, if you're wealthy or if you're poor. It's very simple. It comes down to are you willing to take the leap of faith in yourself and take that risk? And that risk never goes down. You just get more comfortable appreciating it for what it is and what it isn't. And I always point people to that real estate education we talked about in the beginning, because that's the best way to tell. That's your litmus test for whether you have the stomach for this business or not.
Yeah, absolutely. Because again, it's going to give you a well-rounded perspective of what it takes. And hey, if anything, you'll be able to save on, the commissions when buying and purchasing properties. So, it's a great way to get started and get that information that you need. Because you have so much experience and you have been doing this for such a long time, this is a two-part question, Chris. What is the best advice you've ever received when it comes to finances? And what's the worst advice you've ever received when it comes to finances?
Wow.
It's loaded.
Yeah, that's a loaded question. I haven't been asked that one before. Okay, so I've read a lot of books on investing in real estate. My thirst for knowledge and education, I think, looking back on it, hindsight being 2020, the worst advice I ever got as far as real estate investing goes was that you just need to take risks and you just need to just dive in. You just got to get your feet in the game. I think that, frankly, is bad advice, and I think it's short-sighted. It's easy for a wealthy person who's been in the business, who has a ton of real estate, to say that because he, she, or they may have something to fall back on that you, a first-time real estate investor, don't. And let's be honest, we have families, we have kids, we have family that rely on us to make good strategic investments for not only our future but for the family's future. So
Yeah.
to say that almost undermines the level of risk it is that it takes, and frankly, the education that person has gotten along the way. It's easy for me to tell everybody, just jump in, just do it.
Just do it,
Yeah,
guys.
just do it, man. Like, don't be afraid. Well, you can't tell someone not to be afraid of the thing they're afraid of.
Right.
And all I can tell you is an education has a way of taking those fears and making you understand them. So that's been the worst advice. And that's prevalent in a lot of ways online, especially with, the rise of people on social media telling you how you can take this course, for a certain amount of money. And
Of course.
I don't have a problem with the courses and the idea, but just don't dive into it with the belief that in and of itself is going to really take away your fears and concerns. Now, the best advice I've ever gotten. So I started cold calling at 14 years old. I was a big kid. I'm 6'5", 200 something pounds, probably too big at this point. And I had a deep voice when I was young. And my father gave me a title list. For those of you who might be old enough to remember, the title list was this giant report of all the names associated with the ownership of property in a certain area. And my job was to call that title list. And my father was so convinced that me as a 14-year-old wouldn't be able to actually get anybody to apply for a loan. My father was a mortgage broker. He said he'd give me $500 for every application that I got.
Ooh, you took that as a challenge, Chris. For
At 14 years old, yeah.
Yep.
And I had conversations and couldn't get anybody to convert. And this is well before, the boiler room and some of the conversations that we had and people cold calling and Wolf of Wall Street. But what I found really related and resonated with people in those early calls was that those relationships, the people that I could connect to, that I actually understood, were the ones who always converted, the ones who always, made it to the next leap, were willing to listen to what I had to say, even if they weren't willing to apply for that loan. And as I got more and older and sophisticated, the one thing I found is that if you connect with people, good things will happen. And I've built every single one of my businesses and every single thing that I really do to this day under the core belief that I'm more concerned about your relationship than I am about your transaction. And how, Chris, is that real estate advice? Well, I foster relationships. I'm willing to give up money. I'm willing to sacrifice things to get to know people in certain spaces so I can build a relationship, so I can build a rapport. And those relationships have brought me more real estate transactions than I could have possibly ever anticipated when I first met those people. But being in the industry, being in the space and talking to people and getting to know them and actually caring, being somebody who cares about the relationship over time, that's how you build a business. And that's frankly the way you're going to build your real estate business, because here's where it starts. You have a real estate agent, you've got escrow, you've got title, you've got another real estate agent on the other side, you've got a lender. All these people have to connect for this beautiful symphony that winds up becoming property ownership. And the better relationships you have with them, the more they're going to help you help yourself.
Oh, I love it. So nicely said. And at 14 years old, to have such a character building experience as cold calling, because I know plenty of adults that even, well into their career shudder at the thought of cold calling a potential lead or client and, not knowing what's going to happen on the other end. And it sounds like you led initially with the $500. You're like, I want to make a sale. But then once you flip the script and you said, I'm going to lead with understanding these people and finding a way to connect with them, it's like that's when the magic happened. And that can translate not just in the real estate realm, but just in general, right? I mean, to find success, that human connection is really what leads to longevity when it comes to your success in your career and your finances. And I just think that's fantastic advice. So I think that aligns quite nicely, Chris.
Well, I'll tell you something that's funny. I think people get really shocked by this. I found my last real estate deal, the one I actually closed, I think it was a week or two ago, by knocking on a door and just asking. And it's funny because here I am, I'm an attorney. I probably make more than I know I make more than the person who lives there. And, I have a very cushy, comfortable lifestyle. I'm an executive of a publicly traded company at the bank, and I have no need to knock on someone's door and say, hey, I want to buy your house.
Yeah.
And frankly, I have been called a lot of expletive-filled names, and I've been told off. And I don't take that. I take that with a grain of salt. I don't take that as a way to change who I am or to hit my ego. I get it. People don't want to sell. They don't like somebody knocking on their door. But in this one instance, I did it, and I got a home. I think this one I just closed was a single-family residence, and it was in Oklahoma. We bought it for $258 at a price for $265, and I put more than that in to get it ready for rent. More than $7,000 anyway, but. That wouldn't have happened, particularly in this market, had I not have put my ego aside, knocked on a door and said, hey, man, like I would be interested in buying your property. Do you have any interest in selling?
Absolutely. If you hadn't taken that step, right, get outside of the normal comfort zone, then that deal would never have happened because they didn't know they were looking to sell, not until you talked to them about it, right, and had that connection with them that you just spoke about. And so really kind of going outside your comfort zone is critical. I have one last question for you before we start to wrap up. If you could just have the listeners remember one thing and one thing only, right? We've got short attention spans these days. What is your last imparting thought that you want to make sure that the listeners retain from today's episode?
Okay. I thought when I was younger that I really wanted to be wealthy. I didn't grow up with a lot of money. I grew up seeing a lot of people around me have a lot more than I had. And, I'm grateful for all the things that I've learned. I think adversity builds character, but one of the lessons that I've learned along the way that I think I wish I would have learned sooner was that building wealth is not a destination. The journey is the wealth. And you need to understand that you're never going to get to a point in your life where you're like, I'm good. I have enough. And there are people who say that, and then they get there and they want more. And it isn't always about money. It's about the path to get to the next level. It's about your mental development. It's about us as humans are meant to continue to grow. So every day, challenge yourself to continue to build in the skill set that you're interested in, that thing that you love, and good things will happen. And if that's real estate, just keep trying. It's as simple as that.
Guys, you heard it here from Chris Naghibi. I want to make sure that the listeners can contact you if they had more questions or, where can they find you online?
So we're on TikTok, we're on Instagram, we're on YouTube, and I don't sell anything. It's just me giving out good old fashioned free financial literacy. We're trying to help people. That's really all we're doing. And you can find me. My handle's the same everywhere. It's at Chris Naghibi. My last name is spelled Naghibi. Feel free to connect. I'm very reachable. Ask me any question you have.
Oh, thank you so much, guys. Again, we just talked about the human connection and relationships. And Chris, who has tremendous experience, just offered you to reach out and to ask him a question. And so, if anything resonated with you today, reach out to Chris. Make sure that you connect online because that is a relationship that you can start to foster and to build today. So, with that, Chris, thank you so much for coming on the show. And for all of you guys listening, thank you so much for tuning in. If you're not already, make sure that you're following us. We're also on TikTok, Instagram, all the socials. It's at Financially Free Journey. I post daily tips and motivation to help you on your financial journey to success. Until next time.